portfolio. But for most people out there, they need to not only consume the yield, but they are going to have to tap into some principal also. Other clients also, they don't want to just live on interest. They want to tap into their principal because they're not worried about dying with this big benefit for their beneficiaries, right? They want to consume this money and enjoy it for themselves. And so the other way is to establish what we call a drawdown approach, where we're drawing down both principal and interest in earnings. And so, Conrad, this is that concept that you mentioned of like establishing a soon bucket. So, if
Right.
we were designing a plan for a client and we determined that outside of their Social Security, they were going to need another $65,000 a year to live off of. So let's say their Social Security is 40 grand. They need another 65. That gets them to about $105,000 a year of total retirement income. In that soon bucket, David, about how much would we want to think about putting in something that's going to be invested for growth to help offset inflation? It's just invested conservatively so that it can generate that reliable income in kind of that drawdown phase. Like if you had maybe a more aggressive investor, about
Mhm.
how much would be in that soon bucket, or if you had a more conservative investor, how much might be in that soon bucket if they needed, around 65 grand a year to tap into their assets.
Yeah, and again, it's going to depend. And we've been talking with different clients, and they have different appetites for how much they want to put in their soon bucket. But if you're on the more conservative side, you might want to load that up for a 10-year time horizon. So if it's $65,000 a year you might need $650,000 to fill that gap, just to get you through those 10 years. And that's not even accounting for inflation or anything else.
So
So
650 there, and that basically would say, all right, we've pretty much secured a 10 to 15 year time horizon in your soon bucket. Because again, that 650 is going to be invested for growth. It's going to earn money over that 10, 15-year time period. And what that does is it allows us to take 65 grand a year out every year to go spend without having to worry about really what's going on in the stock market.